Good evening, everyone. My name is Siddiqui, Matthew Fischer, and Kimberly Still. Today we'll be talking about the beta for our various companies, Coca-Cola, Pepsi, and Dr. Pepper. So first we're going to start off with what beta is. Beta in relationship to the market. Essentially, beta is a stock's riskiness in relation to the overall market. So a beta of 1 means that the company's stock moves. The company's stock is more volatile than the overall market, while a beta below 1 means that the company's stock is less volatile than the overall market. As a whole, the market risk usually averages at a beta of 1. So some of the things about beta is that beta only accounts for systematic risks, and as compared to unsystematic risks. Systematic risk is risk that takes into account the risk in the overall market, and systematic risk can't be diversified away through various investments. So here are some of the data results we found for our various companies. We're going to talk more about these results in a little while. As you can see, the beta for Coca-Cola was 0.54, for Pepsi was 0.52, and for Dr. Pepper had the highest beta of 0.6. So my company, Coca-Cola's beta was at 0.52, which is relatively low risk for the company. In relation to the overall market, this means that Coca-Cola's stock does not move. Coca-Cola's stock is not as volatile to market changes as the market as a whole. So the reason for this is probably because Coca-Cola is a well-established company with high brand loyalty, and people are going to continue to buy Coke, continue to buy soft drink products regardless of what happens. Here are some of the regression results of basically how we found beta. And this is the characteristic line for Coca-Cola. So as you can see, the actual return, which is emphasized by these diamonds right here, as compared to the predicted return of just the slope line that you see right there. And
I'm sorry. PepsiCo's beta was 0.52, which was really the lowest of all 3 of the companies. What was really interesting about all 3 of these companies is that they're very low beta stocks. So 0.52 is actually high compared to their most recent year. The most recent year, PepsiCo's beta is anywhere from 0.31 to 0.34, which is very low. Especially during a recession, you would think that PepsiCo's beta would have been adjusted during the recession, but it really made no impact. So as far as the market, fluctuations in the market really didn't affect PepsiCo. They kind of stayed stable and strong throughout that period as well, which was very interesting to me. These are our regression results for PepsiCo. So right here, showing our beta. And up here, what I think is very interesting as well is the R-squared results, which represents the systematic risk to total risk, which is total risk is represented by variance. And then this is the characteristic line for PepsiCo. It's only representing 2011, so as you can see, it's a little bit more, very similar to Coca-Cola, but as well, a lot of actual returns were pretty scattered throughout that year as well. So.
All right, and here is Dr. Pepper Snapple's regression results. They're pretty similar to the other companies as well. Right now, we have a beta of 0.63, and this is considered to be pretty low as well. It's a little bit higher than our competitors, but that might be attributed to the fact that it's a bit smaller than its competitors, so any kind of changes are going to affect it more than its larger competitors. And also another reason the beta could be a little bit different is that it wasn't sharing stocks until May 8th of 2008 or May 7th of 2008. So we have 3 years of data rather than 10. And even though its beta is still pretty low, it's pretty similar to its competitors. So there's not much of a positive or negative relationship towards either one of those. And as you can see by the diamond, that our returns kind of go the same as what's predicted for them. A couple of beta's weaknesses are that it measures only systematic risk, which means that it cannot be diversified out. So regardless how many stocks you have in your portfolio, there's always going to be that risk there. Systematic risk is inherent in the entire market. So, like I said, it'll always be present. And beta can be a tool to predict how volatile a stock is, but not whether it'll increase or decrease in value. Therefore, the changes can be negative or positive based on day-to-day occurrences. Any questions?
We're good. We're good. Round of applause. Nice job.